Hello and welcome to Cima F2 Financial Management. This is Chapter 6, IFRS 2, Share-Based Payments. As many of you may be aware, large companies often pay the senior management team bonuses, but in a special shape. So that would be in the shape of shares. And what we are saying is, if the senior management stays with the company, let's say 3 years from this point in time, they will be entitled to excess shares, and the value we give it to senior management will be below market value. Why is that? Because they would get them at that point in time, in 3 years time, let's say, and they can sell it on the stock exchange at the higher tradable price, the market value, and obviously they will get the profit on their own. Now, what happens before IFRS 2 was invented, in effect, you were dealing here with this gain that the shareholders were making on the sale of their shares, and that should have been assimilated to remuneration, isn't it? Because it's part of their remuneration, it's just under a different form. And also, you may be aware from the knowledge of other papers that as you issue shares, as you have extra shares in issue, the share price falls overall for the other shares, which means your current shareholders, other than the ones that are entitled to such a scheme, will suffer, will get damage in their own wealth in terms of the shares they own, because that after the issue will suffer a decrease in price. So prior to IFRS 2, all we are doing is, okay, we issued any shares, we'll increase the share capital and respectively the share premium, and we will debit cash as that was issued. However, IFRS 2 came in picture, and this changed things. And I think on the next page you have one of the best summaries possible out there to tell you what should be your approach if you are tested on IFRS 2. So first step you're going to have to do is to decide on the type of scheme the senior management is rewarded. Is it based on shares, or is it just a payment in cash at the end of a period, maybe linked to the share price or some form of reward, which is a mixture between shares and cash. So once you decide that, you will have to apply a different treatment, and we'll be looking at the equity settled sort of schemes, and that is when you are getting only shares at the end of the period, and of course the cash. May I start just with the cash-based payment, because that's more straightforward, and if you know the shareholder in X number of years will get a cash settlement, all you have to do is to estimate the value of that liability that the plan will generate, basically at the end of the period. That could be in 3 years time, 5 years time from now, it would be in an agreement, in a contract. And what you have to do, this will be a typical liability which will revalue at the end of the accounting period every year until the vesting time, until these shareholders exercise or their right becoming entitled to this cash-based reward. That's a situation where you have cash-based payments. However, the whole standard is concerned with a share-based payment. So if you have an equity settlement transaction, what you will have to do first step is to estimate the total benefit of the share plan to the holders, and let's see how we do that. So that explanation there is multiplying total number of chip shares, and how would I know the total number of options that should be given. So let's say you have 5,000 options on shares. Remember, that should be given in the exam. Maybe you will be said that on X date XYZ company is granted 5,000 options on shares to each of its, let's say, 200 most senior staff. So you're taking this number of options, which we refer here as chip shares, to be issued by the option of the share at its grant date. So you multiply that with what they will call their fair value of option. So fair value of option, other called as well as grant, the value of the share at its grant date. And then you have to multiply as well with the number of participants expected to exercise their right by the vesting date. So number of participants, how many you think from the shareholders will exercise such right. Remember, such information, the fair value of option will be given, number of participants expected to stay and exercise their right will be given, and you'll have informative information, the share price, the trading at the vesting date, and that will be different obviously than the fair value of option. So this is the fair value of option at grant date. Now, next step, once you got that figure, let's say you come up with something like $3 million worth of potential liability in terms of equity payments, you're going to have to work out the vesting period. Very important terminology. The period that the staff, remember the senior management staff, must stay with the company in order to be able to exercise options, and that is given in the question. Could be 3 years, 5 years. Just look out for that vesting period. So the period between which you are initiating this particular incentive and the time they exercise their rights. Okay, so let's say that is, for the sake of example, 3 years. I'm incentivizing the senior management today, and if they are still with us in 3 years, they benefit of this scheme. And what do we do finally? We are in a position to say we can work the cost of the share-based payment for each period. So what you'll have to do as a third step is to say, okay, what's my latest estimate of total cost of the plan? Estimated total cost, and this is the exercise you're going to do. Now what happens is every year you will have a different fair value of options at grant date, although that cannot be exercised, it's used for valuation. So every year that will change. Number of participants, that could change, because every year within the 3rd years, maybe you know of less participants that will want to exercise or more participants that want to exercise. So it's just the number, 5,000 shares, that would remain the same, this particular options, let's call it. So you take the latest estimate of total cost plan, and then you're looking for that vesting date from step 2, divide the amount. Remember, in our case we said, okay, let's make it 3 million for the sake of argument. And the number of years between the grant and vesting date, let's say, is 3 years, so I'm dividing, it's 1 million. And less cost cumulatively already recognized. Well, in our case, because I'm doing year 1, I haven't recognized anything, is 0. But if you're year 1, year 2 already, you would have recognized something. So the first portion of cost you recognize, current period expense, is 3 million divided by 3, that would be 1 million. Next year, when you have the cost cumulative already recognized, is this 1 million in the next period, and that will hit your statement of comprehensive income. So what happens, you have a perfect matching of this cost that will hit the financials within X number of years when the share scheme is exercised, nicely spread over the life when the service is undertaken by the senior management. I hope this gives you a glimpse, and I strongly encourage you to spend a bit of time on these steps to really understand them, and then all you have to do is apply it in question practice. This is IFRS 2 share-based payments. I hope that helps, and best of luck with your preparations.